Well, welcome. My name is Carmen Federico. Today we'll be talking about inventory valuations. How do companies account for inventory? Now, when we talk about inventory valuations, we're talking about how do companies account for inventory on their books. There's a difference between the physical flow of product or goods through the company versus the accounting for such goods and products. So, for instance, a company could have like a company that produces sells perishable foods might rotate their stock. I used to work at the supermarket and make sure all the old yogurts were in the front and the new stuff was in the back, so people would buy the oldest first. So we sold on a first in, first out basis. But when it comes to accounting, whether a company does that or not, doesn't mean they can't use any one of these inventory valuation methods. Because all these inventory valuation methods are cost flow assumptions. And there's three main inventory cost flow assumptions. There's actually four: specific identification, which are used for larger ticket items like vehicles and boats and what have you. But for most part, most companies will choose between LIFO, last in, first out, or FIFO, first in, first out, or somewhere in the middle called the weighted average. So we're going to be walking through this to see how companies determine what items to cost first when they sell products, because they're buying products throughout the year. You think about Home Depot or Lowe's, if they're buying cabinet knobs, kitchen cabinet knobs, the brushed nickel kind. And throughout the year, they're buying these cabinet knobs and dumping them into the bin. They may have bought some for $1 today. 3 months from now, they may buy some more for $1.10 a piece. And then they may buy some later on in the year for maybe $1.25 a piece as cost materials go up. So how does Home Depot know which ones to cost out? Do they cost the $1 ones out first, or the $1.10 ones out first, or the $1.25 ones? Okay, so what companies will do will choose a method. They'll assume that the first ones they bought, the ones for $1, will be the first ones that leave the building in customers' shopping carts, hopefully not in their pockets. Anyway, and then LIFO would say the last ones in, or the most recent ones bought, would be the first ones to leave the building. So those $1.25 knobs would be the first ones costed out. Weighted average would be somewhere in the middle. You take the weighted average of the dollar knobs, the $1.10, $1.25. Again, it's some type of average. Say it's $1.13 a knob or whatever. Okay, so we're going to walk through this in this short illustration of how companies use FIFO, LIFO, and weighted average. So I'll share my screen with you right now. So here we go. Counting is fun. Let's see. Up on my screen, you'll see the inventory valuation method under FIFO. I put this little example together. Okay. The beginning inventory purchases and sales for the month of product X for the month of January are as follows. So January 1st, they had a beginning balance of 40 units at $5 a piece. They sold 30 units. They sold them for $10 a piece, which is good. They sold them more what they paid for them. That's always a good thing. And then on January 15th, they bought some more at 70 units. They paid $70 a piece now. So it's gone up in cost. As you know, costs can go up. They've gone up a lot this year. And then on January 24th, they sold 36 more units for the same price, $10. They didn't raise the price yet. Hopefully they can do it soon because the cost is escalating here. So they should start thinking about raising this price. Okay, so we're going to determine the cost of goods sold and inventory balance for the month using FIFO, first in, first out. Again, this is an assumption. Companies will use this and they'll stick to it. Okay, once they use FIFO, they'll say that it doesn't matter how the product actually flows out the door, whether the $5 unit ones or the $7 unit ones go out the door first, it doesn't matter. They're going to assume something. Okay, so let's fill out this grid. So our quantity is going to be our beginning balance. We have 40 units and our unit cost is $5 a piece. So our total is going to be the 40 units times the $5 a piece is $200 our beginning inventory. Okay, 40 units times 5. So when they made a sale, they sold 30 units. They have to look at what they have in inventory. Fortunately, they only have one layer of inventory. What does that mean? They have only one unit cost. All items are all at the same unit cost. You're going to see later when you have more than one layer, that's when FIFO and LIFO get a little not trickier, but that's where the difference lies. Okay, so then On January 10th, we sold 30 units. So in this cost of goods sold column here, we're going to keep track. This is like an inventory. Think about this as like an inventory ledger, inventory card, if you will. In the system, it's all behind the scenes in the computerized system, but this is what it looks like going on behind the scenes. So in the cost of goods sold section, you have 30 units coming out. And what cost? Well, we only have one layer and it has to be at $5. What else could it be? All right. So our total cost of goods for that sale would be $150. Okay. We sold it for $300 and it cost us $150. Right. We sold 30 units times 10 is $300 of sales, and our cost is $150. So now what do we have left in ending inventory? Well, we had 40. We took 30 away. We have 10 left. And what's our unit cost? Well, it has to be 5. That's the only cost we have. So $5. So, whoops, sorry, $5. So we have left inventory, 10 units at $5 a piece or $50. So that inventory, beginning inventory, $200 is now 150 out the door and 50 still here. So whenever you have any inventory, it's either one or two places. It's either still here or out the door. So you can see of the $200, 150 went out the door as cost, and 50 is still here. Okay. So now January 15th, we bought 70 more units. So 70 units, the unit cost is $7 a piece. So we just added cost 70 times 7, $490 worth of cost added to the books. So now we look what we have in inventory. We still have the 10 units in inventory, right? At $50, right? $5 a piece. But we just added the 70 units. So now we have 80 units in inventory on our books for this product. Okay, $490 of plus the 50. We have $540 worth of inventory on the books, but it's made up of 2 layers now. We have one layer still of the beginning inventory. We still have 10 units remaining of that at $5 a piece. And now we have the new purchase, the 70 units at $7 a piece. So now we have 2 layers. So when it comes time to look at this next sale, we sold 36 more units at $10 a piece. FIFO says the first ones in are the first ones out. So if we look under here, we have to look at our 2 layers. We said which ones are the first ones in, right here, these 10 units. So these 10 units are the first ones out as cost of goods sold. Okay, so that's out the door. And then what do we have left? We sold how many units? 36. So we have 26 more units to go. Well, since these are all gone, the 10 units at $5 a piece, all we have left to look at are the $7 a piece units. So those are at $7 a piece. So our cost of goods sold would be $182. Okay, what do we have left in inventory? Well, the first layer is all gone. These 10 units are all gone. So what do we have left? We had 70 at $7 a piece, but we sold 26 of them. So we have 44 units remaining at $7 a piece. So 44 times 7 is our ending inventory, or $308. So the total cost for the month would be, we have $150 plus the 50 plus the 182. Our total cost of goods sold is 382, and our ending inventory is simply 308. One layer of inventory, 44 units at $7 a piece. Okay, so that's how you handle FIFO. Again, the first, you're always looking at the layers. You start at the top and work your way down. If we had multiple layers, it doesn't matter how many layers you have. You want to always start at the top and work your way down until you deplete or use up all these layers of inventory. Okay, so if we journalize this for the period, we have to record, let's record the sales for the month and the costs for the month. Well, whenever, because we're under perpetual inventory method, we always have to record the ins and outs of the inventory when it comes in and when it goes out. So we want to make sure that we record the cost of goods as well as the sale at the same time. So here we are, we record the sale, accounts receivable. Let's assume we sold them all on credit. How many units did we sell? We sold 30 and 36. So we sold 66 units at the price of $10 a piece. That's $660 of accounts receivable, and the corresponding entry is to sales, right? So we debit accounts receivable and we credit sales to record the sale of the 66 units. At the same time, we have to record the cost of goods sold because inventory is leaving the building. the cost of goods sold, we already calculated that. That's $382 for the month. And we record the movement of inventory, leaving the building, $382. Okay. So what's the gross profit for sales for the period? Well, the gross profit is your sales minus your cost, goods sold. So we have our sales of $660. We subtract our cost of goods sold of $382. Our gross profit is $278. Okay. Inventory, ending inventory cost was what, the $308 ending inventory cost. And then we have inventory under FIFO. Is inventory under FIFO would be higher or lower than the other inventory methods? Is it higher or lower? Okay. It should be higher because we're going to see when we do LIFO that it's comprised of the most recent purchases. We have $7 unit costs here in inventory. When we look at LIFO, we're going to see we still have some of the earlier costs because we're depleting the most recent purchases first. Okay, so this is FIFO. We're going to use the same thing for LIFO, same example, just under LIFO. So we'll move it over to the next tab, and you'll see the same information here. So we have our beginning balances, 40 units at $5 a piece. So that's $200 of beginning inventory. And we sold 30 units. Now, again, same as the last example, we only have one layer of inventory here. So all we can choose is the $5 unit cost. So our cost of goods sold will be the same under LIFO or FIFO because we still only have one layer. If you always had the same cost of your purchases, LIFO and FIFO would be no different. They'd be the same exact. But because you're buying at different times and different costs, the different costs will create different layers, and then that's where LIFO and FIFO will differ. Okay, so then we have our ending inventory, 10 units at $5 a piece, as we saw earlier on the FIFO example. So on January 15th, we bought 70 units at $7 a piece. Again, the $490 of cost. And now we have, again, 2 layers of inventory. We have the 10 remaining from January 10th, still there, right? The $10 times 5. And then we have the 70 units at $7 a piece, 490. So we have $540 of inventory, but we have 2 layers. Some at $5 and some at $7. So on January 24th, we sold 36 units. So LIFO says that the last one's in are the first one's out. So we know that these 36 units sold, we costed out at $7 a piece. Okay. And what do we have left in inventory? Well, we didn't touch the 10 units at $5 a piece. That's still there. Whoops. And we now have how many units of the $7 piece items? So we have 70 minus the 36. We have 34 units remaining of the $7 piece items. So LIFO again is looking at, you start from the bottom and work your way up the layers, how many layers you have. Here we have 2 layers. So LIFO says the last one's in, or the most recent one's in, the first one's out. You can call this one RIFO instead of LIFO. Okay. Most recent in, first out. Last in, first out. Okay. So what are we left with? 2 layers of inventory. Our cost of goods sold for the month would be the $150 plus the $252 is $402. You notice the $402 under LIFO is higher than under FIFO. Why? Because we're costing out the most recent or higher priced items first, higher cost items first. Okay, our inventory valuation will be lower under LIFO. It's 288. Back in FIFO, it was 308. Okay, so under normal rising prices, LIFO will have the higher cost of goods sold, but the lower inventory valuation. FIFO will have a high inventory valuation, but lower cost of goods sold. Okay? They're the opposites of each other. So if we journalize these transactions for the month, accounts receivable, again, we still have the 66 units times $10 a piece. Okay? And that's accounts receivable debited and sales credited to record the sale of this merchandise. Okay? Assuming it's all on credit. And then we have to record the corresponding cost of goods sold. Again, these two entries go together. You can't have one without the other. They're under a perpetual inventory system. Cost of goods sold is going to be the 402. And we're going to credit the inventory account because inventory is leaving the building. Okay. So the cost of goods sold for the period is going to be, again, sales minus cost of goods sold, give you a gross profit for the period of 258. This gross profit is less than FIFO, which was 278. Why? Because LIFO has a higher cost of goods sold. Sales minus cost of goods sold equals your gross profit. Inventory cost is going to be 288. It was 308 under FIFO. And inventory under LIFO will be lower than FIFO. Okay, lower. It's a lower balance. It's 288. It was 308 under FIFO. Okay, and FIFO. So we looked at FIFO, we looked at LIFO. Now we go to somewhere in the middle called weighted average. If we don't want to have either polar extreme, companies will choose to use LIFO if they want to minimize their taxes, because LIFO has a higher cost of goods sold and it will produce a lower net income. You make less money, you pay less taxes. However, if companies want to maximize their book income and show a higher book income and balance sheet, they'll use FIFO. Again, it depends what they want. They can't use both. They have to choose one or the other and stick with it. They just can't waffle back and forth year to year. They stick with one and they use it. Okay. If they want something in between, as I mentioned, weighted average would be the way to go. Here, every time you have you buy some new product, you have to calculate a new average cost. Okay, so let's look at it. So we started with the same beginning balance. Nothing's different yet. We have our same beginning inventory, and we have a sale of 30 units. So we sold 30 units, and what cost? $5 a piece. What else can we use? That's the only unit cost we have. What's left in inventory? The 10 units at $5 a piece. Okay, so nothing's different so far between these three inventory assumptions. So now we come to January 15th, we bought 70 units at the $7 a piece, right? The same $490. So now, what do we have? Whenever you have a new purchase, you receive some more product in, you have to calculate a new average cost. Okay, and why is it weighted? Because it's weighted by, well, we have 10 at 5 and we have 70 at 7. Okay, a simple average would be 5 plus 7 is 12, divided by 2, you get $6 a unit would be a simple average. But this is weighted average. It's weighted because you have more product at 70 units at $7 than you do at $5. You only have 10 units. So we come here, we put in the full inventory valuation. We have 50 units, $50 plus the $490. We have $540 of total inventory. And we have total units of the 10 plus the 70. So we have total 80 units in inventory. So we simply take the $540 of total weight of the inventory, cost of inventory, 540, divided by the number of units. We get a unit cost of $6.75 per unit. That's a weighted average cost. Again, it's not $6, would be a simple average. It's $6.75 because you have a lot more units at $7 a piece than you do at $5 a piece. So now, excuse me, when it comes time to make this, to record the sale, these 36 units are going to be costed out at $6.75. So 36 times 675 is our cost of goods sold of $243. What's left in inventory? We had 80 units and we just used up 30, sold 36. We have 44 units at $6.75 per unit. And so our ending inventory is going to be $297. So we get the cost of goods sold for the period. You have the 150 plus the 243, you have $393. If you look at that, the 393, which is lower than the LIFO, but it's higher than the FIFO. It's somewhere in between the 382 and the 402. Weighted average is 393. And the ending inventory is simply going to be 297. Again, somewhere in between the 288 and the 308 for FIFO and LIFO. Okay. So that's weighted average. The key is calculating a new average cost every time you make a purchase and record more inventory coming in. So again, the entry will still be the same. Debit account receivable for the $660 in credit sales. Okay, no different there. The cost of goods sold has still have to be recorded. Cost of goods sold would be in this case $393, and we credit inventory leaving the building. Okay, and gross profit for the period, sales 660 minus cost of goods sold of 393. We have 267. Again, somewhere between the LIFO and the FIFO gross profit. And the inventory cost will be 297. So weighted average, again, somewhere in between the two polar extremes of FIFO and LIFO. Hope this video helps. I hope you enjoyed this video. Stay tuned for some more videos. Accounting is fun. I'll see you next time.